morning. Welcome to our Monday market update with Scott Zelniker and Ryan Lynch, presented by Zelniker Dorfman Private Wealth at Stewart Partners. Today is August 3rd. It's 10 a.m. Eastern Time, and we're discussing key themes driving the markets this week and forces shaping the economy over months and years ahead. Scott and Ryan, thanks for joining us. Let's get right into it. Scott, we've heard you talk about the ingredients that are in place for a positive backdrop for stocks. Can you elaborate on that?
Yeah, we're in a really unique time right now. And without getting political, because I don't think politics has any place in this, I will say that we're in a period with deregulation, favorable tax policy, and increased productivity. The increased productivity is really being driven by the technology revolution that we're in. And if you've seen me speak on other TV networks, you would have heard me talk about this technology revolution. In the 1600s, we had the agricultural revolution. It lasted about 200 years. In the 1800s, we had the industrial revolution, lasted about 200 years. This technology revolution that we're in started in 1980 plus or minus. So we're 40, 45 years into this technology revolution. And I believe it's going to be a tailwind for us for the foreseeable future. For the rest of my investing lifetime, we're going to have this tailwind. Now, that doesn't mean the market's going to go up every day, every week, every quarter, every year. It's going to be ups and downs and ebbs and flows. It also doesn't mean that it's just going to be technology stocks that benefit. And Ryan, I know you and I have talked about this a bunch of times, right? It's the efficiencies across different sectors. So Ryan, maybe you could kind of play off that and talk about, some ways to play this technology revolution that's not directly tied to tech.
Yeah, absolutely. And you bring up a great point, Scott, right? When you talk about revolutions, there's always winners and losers. So there's been a handful of companies that have really accounted for what I would consider outsized market gains and market share. So for investors, the temptation often is to go to what's worked in the past. But as we know, history is not always indicative of what's going to happen in the future. So I like the idea of taking a broader approach to the participation. And what does that mean? That means looking at AI infrastructure, right? We talk about semiconductors, cloud providers, the actual data centers themselves, the energy needed to power all of this, and the battery power to store the energy. And then you look at other industries that are going to benefit from increased productivity. In healthcare, there's incredible transformative technology and innovation going for cancer treatments and diagnoses and the like, financial services, manufacturing, logistics. So there's an endless amount of areas that are being impacted by this AI revolution. So I don't think you really need to own one stock to benefit from this trend. I think you need to broadly participate and just be in early.
So Jordan, one thing we've seen this year, we've seen the equally weighted S&P index outperform the traditional market cap weighted S&P index by quite a bit. And I think that's really what Ryan and I are talking about. It doesn't just have to be tech, but that tech tailwind is driving it all.
Yeah. And Ryan, you talked about AI from a productivity standpoint. From an investor perspective, what's the right way to start think about participating in AI revolution without taking excessive risk?
Well, I think part of it is like I said, being part of a broader investment strategy. So Scott mentioned the equal weighted S&P. We've invested in that for quite a while. And really looking at what we're seeing lately in the markets is a little bit of a rotation away from just the semis that have really led the last few years. So with inflation continuing to moderate, hopefully over time, interest rates, we'll see what they do with this new Fed, and focusing on, like I mentioned, financials, industrials, healthcare, infrastructure, even some small caps, which Scott and I have been in favor of for a little bit. Those are great areas to participate in. Because remember, within a long, strong secular bull market, leadership is going to rotate, right? Not one thing lasts forever. So the question is whether AI stops winning. Again, I agree with Scott. I think this is going to be a long-term tailwind for most of our life. But the question is when everyone else starts participating. I think we're starting to see a little bit of that.
So, right, you mentioned for the last several years, semiconductors and AI related companies have dominated market returns. Are you seeing that leadership could broaden into other sectors of the market here?
I think we're starting to see a little bit of that, and that kind of is going to come back to a few factors, right? We're in the middle of an earnings season, so we're seeing what other companies are starting to do and forward guidance um, they're showing. But also, the Fed's going to do a lot of this too to see what areas are more impacted than others if they raise rate or cut. And I know Scott's been talking about this for a while. Scott, you could probably talk about this where for a while you were saying that they shouldn't be cutting, right? I know you were on Maria's show talking about that for a while, that they should just be holding. And now you're saying that they should be cutting into potential weakness in the economy. Is that right?
Yeah, yeah. So I was in the minority, for the last couple of years after inflation cooled, people were saying cut rates, cut rates, cut rates. And yes, I was on other programs talking about this. And I flat out said, I said, if bombs go off in Iran and oil fields are hit, we're going to see a spike of inflation. And the Fed needed to hold its dry powder just in case that happened. Fast forward to where we are now, right? We had a strong economy, or strong enough economy. It was growing. Stock markets were reacting well. There was no reason to go in and stimulate. Now inflation is rearing its head in. It's from geopolitical events. It's not excessive demand that's creating this. It's this geopolitical event, the wars, oil prices spiking, creating inflation. The big risk here, in my opinion, is not inflation, it's stagflation. You've heard Jamie Dimon talk about it. Others have spoken on it. The 1970s style stagflation, where you had inflation and a stagnant economy. That's our risk. So how do you ward that off? You cut rates, you stimulate the economy. The inflation's going to happen either way. Simply raising rates, as long as the situation in the Middle East is unstable, it's not going to cool inflation. No matter what you do, all it's going to do is choke the economy. So what's the right move here, in my opinion? Cutting rates. Now, having said that, nobody's called me to ask me my opinion, but to me, that's the logical outcome from here.
Yeah. And we've talked about AI, interest rates, and market valuations on this session. If you had to pick just one factor that'll have the biggest impact on the markets over the next 12 months, what would it be and why?
Well, look, you just asked, one factor. Obviously, earnings matter. Ryan, I know you talked about earnings season, and they've been pretty good so far, right?
Yeah.
Across the board.
Yep.
And I think a lot of market reaction has been predicated on the commentary after the earnings call. And I think companies are grappling with, am I spending too much on this AI build out or too little on it? And as long as that pendulum is going back and forth, we're going to have, you know, some volatility in the marketplace. And I think the other thing you have to look at is, as the Fed comes out with their interest rate decisions, there's always volatility around that. So what they do and what the market reaction is to that is what's going to set, some of the action over the next 12 months.
Ryan, what would you say would be the biggest impact on the markets over the next 12 months?
I agree. I think that in the short term, geopolitical issues and the price of oil, which had been dominating the market, and short term fluctuations is going to continue to do so until we get some sort of a resolution. We'll see when that comes. And to piggyback off of what Scott said, the second thing I would focus on that's kind of been a little bit of a headwind to this AI revolution is not just CapEx, but it's the forward guidance that these companies are showing during earnings season. Earnings have been very strong, like Scott mentioned. So it's not necessarily what they're reporting on earnings day, it's what they're anticipating is going to be moving forward, because there's a lot of outsized expectations that a lot of these companies, even though they're growing at rapid rates and are crushing earnings, they're falling victim to maybe not guiding as lofty ahead as what some analysts are expecting. So those are the two things that I'm watching.
Great. Thank you both for sharing your insights and perspectives with us. Thank you to everybody who tuned in to listen. We'll be back next week to discuss the latest developments shaping the investment landscape. You can find us across all platforms at ZDTV and Zelniker Dorfman Private Wealth.